Hi everyone, this is Shaurya and you are watching Money9 Jhatpat. RBI has raised interest rate to contain inflation. Repo rates has been increased by 0.4% to 4.4%. However, can we control inflation? Also, what will be the impact on economic growth? That's what we will tell you in this video of Money9 Jhatpat. Well, let's look at the economic situation. If we come to goods sector, situation is gloomy. Demand is there, but shortage of supply is acting as a constraint. Whether it's electronic industry, automobile industry, shortages of raw materials are cause of concerns. COVID, along with geopolitical tensions, have hampered global supply chain, and this integration of the world, which we say globalization, is now acting as a bottleneck in the economic recovery of India along with the whole world. Due to this, commodity prices are on a roll. This has forced companies to increase the prices. However, they are unable to completely pass on the cost because that would seriously impact the demand. Quarterly earnings of FMCG companies depict increase in revenues, but volume growth is marginal if it is there at all. Companies are even reducing the size of packets, which is being called shrinkflation. Now, there are some good things. On the brighter side, as COVID is fading, service sectors have started reviving, and this revival can trigger expansion in the contact-intensive industries. Companies have cleaner balance sheets, and CEO surveys indicate a new wave of capex cycle. Also, with normal monsoon, kharif production can be good, which can be helpful in reviving the rural economy. From FMCG sector to two-wheeler industry, revival of rural economy is important. Exports have finally started increasing after being stagnant for quite a few years. Even GST collections are high, but inflation has a huge role in high GST collection. With this, let's move to inflation. Clouds of inflation are looming and are all set to spoil the party. Retail inflation ebbed close to 7% and reached 6.95%, while wholesale inflation has reached 14.55%. And this is not just domestic phenomena. Rising inflation is a cause of concern for whole globe, and it has brought central banks across the developed countries in action. Bank of England has already started rate hike cycle, Fed has joined the party, and RBI gave a bouncer by announcing surprise rate hikes. It has increased repo rate by 0.4% to 4.4%. Repo rate is the rate at which banks borrow money from RBI. This is a barometer for a direction of all other interest rates. So, it means that all the interest rates across the boards are expected to increase. This is done to reduce the money supply of the economy, which in turn will help in reducing the inflation. So, will this decision control inflation? Well, until supply chain bottlenecks and geopolitical tensions are resolved, trade routes will be impacted, ports across the globe will remain congested, freight rates will remain elevated. These are the real factors behind inflation. Can RBI, Federal Reserve, Bank of England control these? No. Also, impact of central bank decisions comes with a lag, which means it takes some time to come into effect. Till then, inflation may continue its demonic dance. And on the other side, this will increase the lending rates, which means taking loan for buying a car, home will become expensive, and that will impact the demand of these products. Even the cost of borrowing for companies will increase, and that may impact the capex plans, which may also impact the capex cycle. Even stock market will react negatively because high liquidity was the drug which was fueling the boom in the share market. Now, all this suggests that inflation with low economic growth will be there, and that is the dreaded stagflation. So, with improvement in supply chains, central bank policies coming in effect will improve in the medium term the economic condition.